everyone. Welcome to CFO IQ. I'm your host, Andy Zizas. On today's show, I'm joined by an accomplished finance executive who possesses a very diverse background with a concentration in PE-backed companies. Joining me today here on CFO IQ is Ying Miao, Chief Financial Officer of Converge. A little background on Ying: leading finance, HR, and legal, Ying Miao has a track record of driving operational excellence, profitability, and sustainable growth. As CFO at ad tech company Philo, she led global finance and accounting, achieving critical milestones, including a successful Series C3 bridge round. Ying's experience includes building and refining financial strategies, developing KPI tracking systems, and advising on international expansion. Ying has worked in venture capital, managing due diligence on investment targets, and raising funds for high-growth startups. She holds an MS in International Relations from Georgetown and a BA in Economics from Harvard. Additionally, Ying is a former concert pianist who has performed at Carnegie Hall and Lincoln Center. On its website, New York City-based Converge calls itself an agency of action and describes itself as an unlikely band of media specialists, data geeks, digital gurus, and marketing enthusiasts, designers, developers, analysts, strategists, and engineers who share a simple vision. All marketing should perform. Today, Ying and I will discuss CFOs driving PE growth. Ying, it is wonderful to have you here on CFO IQ. Welcome. I'm glad you're able to join us today.
Andy, thank you so much for having us. Thank you for CFO IQ to host this. I'm super excited for today's conversation.
I am too. And you know what? Before we start, I've got a really important question. Mm-hmm. A concert pianist? How thrilling was it for you to be on stage at Carnegie Hall and Lincoln Center? Tell me a little about that.
Oh my gosh. So I started playing the piano when I was 4. My mom had actually bought the piano before I was even born. So she was very committed to this idea of her child playing. And I really developed a passion for it, worked very, very hard. I played in Lincoln Center at age 11, and then Carnegie Hall later at 13, Kennedy Center also at 13. So really, really young. And I think that helped me kind of be a little bit more open kind of just around the stage, right? And not afraid and being able to be comfortable in my skin and present. So it was very good training, kind of sometimes for the boardroom, I would say these days.
Wow. That's incredibly impressive. I couldn't agree with you more about the confidence and the comfort that being on stage develops in young people. I've never played at Carnegie Hall. I've never played at Lincoln Center. I'm not a concert pianist, but I am a rock and roller from way back, and I still get on stage. I still get on stage occasionally and sing at the Jersey Shore.
That's amazing. You got to tell me where, because I've definitely gone to Jersey Shore, so I got to support you next time.
All right. So we'll talk some more. So today we're going to talk about CFOs and PE. So let's begin our discussion specifically about the CFO role at PE-backed companies. How does that role change when you're operating inside, or how does the CFO role, I should say, change when you're operating inside a private equity-backed company versus that of a traditional public enterprise?
That's a very, very good question. I think it's something that I've faced because not so much that I've worked in large private equity firms myself, actually, as an investor. But then now sitting kind of on the operating side as CFO. And I've also worked for a startup, worked actually as an FP&A analyst at Anheuser-Busch InBev, which is publicly traded, right? But not as in the CFO role. So those are, I've definitely faced some of those questions before. I would say some of the big differences is at private equity firms, a lot of it is around creating value, right? And strategy. It's a lot more strategy, value creation, a lot more hands-on with one specific group, right? And it's not just about reporting, because I feel like definitely on my stint at Anheuser-Busch InBev, there was a lot of strategy internally, but when it came to reporting and when we were hearing the CFO kind of do quarterlies and the annuals, a lot of it was right for a very broad public audience. And there was not as much room for kind of back and forth or for investor involvement. Or, the board was active, but still, this was for very public facing, so broader subjects and getting the reporting requirements correct very, very important. Timelines, very important. But I think as a private equity sponsored, right, company, it's so much about how do you work well with the PE value creators, and what are their goals, and how do you fit in into their whole entire portfolio, and then being able to strategically execute that and then tell a story where it makes sense to them, I think is some of the fundamental differences.
Hmm. That, you know what? That makes an awful lot of sense. And I find that PE sponsors are very demanding and sometimes very unique in their expectations. But what I'd like to get from you is what have you seen that PE sponsors often underestimate about portfolio company finance teams, and how do you bridge that gap as CFO?
Yeah, I think that what they underestimate is how much time as well as key kind of critical talent it requires on the finance team to do this well. Because it's I think for them a lot of it is like should be pretty simple. Maybe it's Excel models, it's reporting. Maybe some of their questions, they kind of ask the same things across the portfolio companies. But depending on the business and the structure, some teams may not have that infrastructure built out. So I think there's a lack of what, depending on the asset you buy, their stage of financial transformation or digital transformation, or how involved they are with key critical KPI building can be lower or higher depending on how large they are and how developed they've been before and what the prior owners had done before, right? So I think I've seen all kinds. Just to give you an example, at Converge, when I first joined, we were still on QuickBooks, and this is not a small startup, and yet I would say some of the financial infrastructure was lighter, right? And even today, I'm pushing for AI FP&A tools and having reporting kind of at your fingertips. And then besides that, being able to have this communication cadence that makes sense for the PE investor. So another example, which I think is underestimating, is sometimes they'll just say, I have one question: what is the current cash flows of this business, right? That one question could open up a can of worms because we may not be tracking it in that way. And so since I joined, we've had to build out a lot of dashboards and models and kind of scenario planning just for the investor, because that's how they want to look at their business, how it fits into their reporting versus just what we're using for the business. And so I think that bridging that gap is sometimes something that they may underestimate.
All right. So staying with the whole PE idea, holding company structures, can be very interesting.
Yes.
In a holding company structure, how do you decide which decisions should be centralized versus left at the operating company level? I'm sure our CFOs who are listening today going to be very interested in hearing your thoughts on that.
Totally. And kind of going back to sort of the holding company structure. So I was more on the investor side. I was at McAndrews and Forbes for a couple years. And they're very well known for having, they had at the time 7, 8 large portfolio companies that all rolled up to MAFCO. And so I think having worked there and then now sort of at one, at the PE level, with a sponsor backed one entity, what I've seen as a difference is when it's a portfolio model, you kind of look at what could benefit the total and each one, but then how do you sum up, right, all the parts together? And then are there things that you can leverage across the platform? So sometimes, for example, at the holding company, we'll look at one tool or one software, and we're not just thinking about the gaming company. We're thinking, all right, what about the gaming company and cosmetics? And can it also apply to media and marketing? And if so, what are the kind of savings and ROI that we can calculate across the board? And it's the same thing with when it comes to debt structures and negotiating kind of new contracts or even taxation or tax law, right? And all of those, we think about it in terms of at the holding company level, are there things we can do that maybe may benefit one, and for the others it's less beneficial, but overall the numbers calculate up to a much bigger savings or impact. And so it's very much in that way. And I think what you keep at the holding company versus what you keep at each portfolio is really what's, hands on the ground, sales, localized decision making is really where people like are on the ground and can figure that out better versus like higher up strategy, whether it's like AI platforms or technology, maybe that, or even ERP systems that may be better made at the holding company level because it's kind of, you look across the board and at the frontline center of what strategically makes sense versus each kind of nitty gritty branch.
Okay, you know what? That makes a lot of logical sense. And that ties into my next question as it relates to decision making and capability and disciplines. We find that CFOs, whether they do or don't have experience with PE, makes a big difference. And I guess my question to you is, from a discipline perspective, what financial disciplines should PE-backed CFOs build earlier than they might in non-PE environments?
I love that question because I frequently have this debate with my CEO because it's her first time working for a PE backed company, right? As a CEO, she had prior, been at very large marketing media companies, right? Publicly traded, also private startups, and she's like, wow, this is super different. And I was like, I completely agree because sort of the muscle that you need for private equity firms, I think there's two. One is the ability to communicate in their language. So they have a particular way of looking at financial discipline, modeling cash flow is so important for them, sort of the cycle, right? Understanding where their cycle is and what do they ultimately want as an outcome. And PE firms differ. It's not everybody's saying, I have a 5 year timeline, I need to sell. Some people want to hold, actually, private equity firms can hold for 10 years, 20 years. Some end up being a holding company structure. Some want an even shorter timeline, right? Some just want to say, I want to get a partner in and I'll just lower my stakes. So it's all about what is their ultimate goal and how do you kind of service that goal and being able to communicate and build trust. And so I think having that language, and I benefited from having worked for private equity firms and worked on the investor side because I know exactly kind of what the investors are looking for and why they're asking some questions. And so that helps me in kind of projecting out earlier what they may need in terms of reporting, right? And also not taking things at, the wrong way. If you're like, why are they asking all these questions? Do they not believe my, P&L or balance sheet or cash flow? Why do they want to look at all the nitty gritty and a bridge of this and a bridge of that? I think I've had to help my CEO also understand this is actually helping their investors because they've got LPs. This is not because they don't trust what we're doing. So I think that part is really important. And I really do think like with private equity firms, I look at them as a true key partner. They're not just like a, publicly traded, you don't know really the investors well, right? This is where relationship building is super important. And so all the board meetings, all the cadences, the phone calls, they have all my, the three main partners at this firm have my phone number. They call me at any time. I'm like, I'm an open book. Don't feel like it has to be a structured email because I think that relationship building. My CEO caught dinner the other night with the PE firm, just one on one, not talking about business. And she said that was super helpful. And actually, one of her friends and former colleagues suggested that. And I would say that piece of relationship building is so important because it's two people at the end of the day.
Yeah, I could not agree more with everything you said. And specifically, you talk about relationship building. While I'm not sure relationship building is a discipline, maybe it is. I think also from the CFO perspective, there's in order to succeed as a PE CFO or a new PE CFO in particular, what I found is essential is a change in mindset.
Mm,
I've encountered CFOs who have been non-PE CFOs for majority of their career, running entrepreneurially owned or family or founder owned
yeah.
companies who make the shift to PE CFO without making the change in mindset. And when I say mindset, I mean the conversation that I've heard tends to be the same sometimes, whereby the CFO says, these investors we've got now, they don't care about the company as much as we do. They don't love the company the way we do. They don't have the same emotional connection to the company that we do. And it's a comment of frustration. And I
Yes.
look at them and I say, yes, you're 100% right. They don't love the company the way you do. They're not emotionally connected to the company the way you are, or the founders are, or the previous employees are. They're involved with your company to to accomplish a very specific objective,
Yep.
to accomplish a return,
Yes.
to secure enterprise value for the company and to drive growth. That's it.
Yep.
So the
Yep.
sooner as you, as original CFO converting to PE CFO, the sooner you get that, you'll realize that it's not a negative. It's actually a tremendous positive to have partners who are so laser focused and don't have to worry about removing the emotional aspects that other people involved who were previously involved in the company may still carry. Would you
Yeah.
agree with that?
I totally agree. I think that you put it very, very nicely because I think that emotional aspect is sometimes where things may go wrong if the mindset doesn't change, right? Because I think that for and the PE firm, it's rightly so. I mean, they have a lot at stake. They have a lot of money at stake. And so for them, yes, to be laser focused, and I think that it's actually good. It can be very good. Obviously, there's bad cases, but many good cases where focus on bottom line helps the company. Maybe the company before was not run in a manner, whether from a software perspective or process or operation and expenses perspective in a professional way. Now you have people saying, why justify these expenses, justify these people to me? And actually, that's a good thing because how do you become the best at something without really going laser focused on is this making money?
Right, right. We're on the same page, exactly.
Yeah.
And to continue that thought, when you're talking about value creation, driving growth, accomplishing the bottom line objectives, how do you manage PE investors' value creation timelines and the
Sure.
long-term health of the business? I mean, it's a great follow-up to what we just talked about.
Yeah, yeah, I love your questions, actually, Andy. I think it's so much of what I'm thinking about day to day because the PE firm definitely, and we're unique today. We work with Blue Torch, who I have to say is a very supportive, has been a very supportive partner. They've invested a lot of money with us, continue to have. They are very actively involved. We probably call them once a week at a minimum, right? So they understand, really get in and roll up their sleeves. But I think their timeline is a little different. It's not a very hard and fast. It has to be 5 years or 7 years or whatnot. What they have always kind of asked me is, what do you guys think? When do you think it's a good time to sell, right? And part of that calculus for me is I run ROI scenarios just on their investment and debt and based on our EBITDA and based on market context. And my CEO and I also have calls with consultants and bankers to kind of get their perspective. Hey, what are people selling at these days? Where do you think the market's going to trend out in 2 years, 3 years, 4 years? Is it a holding company that would be interested? Is another private equity firm? And I collect these data points, not so much for a sales process, but really to build in that confidence and work as a dialogue and partner with Blue Torch and say, hey guys, let's think about it in a 6 year or maybe a 7 year time frame, for example, because I've gotten all of these feedback and I'm looking out for your interests. So that's kind of what I try to posit. But when it comes to balancing that piece, right, that timeline with the business, I think it's constant day to day. For us, we're thinking about 12 months, 18 months. We want to accomplish certain goals in the business. And sometimes it may not always follow that 5 year, 6 year, 7 year. So what I try to do is I try to have over communication kind of with the PE firm, but also with our leadership team and say, you understand there's a certain timeline on their side. However, we have to do what's best for the business. So let's have an open dialogue about what time makes sense where both our trajectory and their ROI has a meeting point. And so I think this constant, and I do a lot of scenario modeling because of that, because times change, markets change, right? People change. And so it's never a fast and hard answer. And I'm glad I work with a partner where it's not like our mandate is we have to return to LPs by 2030, right? Like it's not that, because if it was that, I think there is a bigger challenge to kind of balance with business goals.
So we're talking about over communication. We're talking
Yes.
about maintaining partnerships and having solidly connected relationships
Yeah.
for the betterment of the company and the company's bottom line, but also in accomplishing the goals and the objectives of the PE firm.
Yeah.
But at some point, it comes down to formal reporting, right? So
Yes.
talk to me about, what's really great reporting look like in a PE company, and you can communicate that in a holding company context if you like. But I want you to talk about more than just speed and accuracy, because you have to be fast and you certainly have to be accurate. But beyond that, what do you think great reporting looks like?
So I think the top of the line reporting, this is something actually we're working towards, is honestly if everything was on a single platform, it's no longer even Excel based or email based communications, but there is a portal that both internally, because I really believe in transparency. I don't believe in, sure, there's a crafting of there's always messaging, right? Because numbers are just numbers. If you read it just black and white, it sometimes may not make sense. So, but however, I don't believe in kind of hiding things either from a business counterpart or my CEO or my business person or even the PE firm. I want everybody to have the same number, see the same number. So, what our company is working towards is actually we're building something in house. We're also probably going to go with the software to do an FP&A AI tool where reporting is kind of all the P&Ls, the balance sheets, the cash flows. We have a 13-week cash flow, right, that we send out right now weekly. So I would say when it comes to great reporting, cash flow is probably number one on the private equity firm's list because they care about cash. It's really that's their measure of how good the company is doing on a week to week, kind of 13-week, and actually we do for the full year. It's not just 13-week. We go from beginning of January all the way to weekly cash to December 31st. So we can see it the full year. So it's a very detailed model. And then of course we have, the monthly reporting right now that also goes out in a little binder and a little Excel PowerPoint, which I all want to live on this platform that has our income statement, balance sheet, monthly cash flows, as well as our budget, right? Because we set a budget, it should be in there. And then we also have reforecasts. We do quarterly reforecasts off of the budget to see, are we ahead or below plan? And what's our forecast for the rest of the year? So everybody knows, are we on track or not on track? And I think those three components, right? The budget, the reforecast, the cash flows, as well as all the other components should be in one portal where you open it and it's just tabs and you can see it at any time you want. And at most, it's kind of maybe calling me for more context, or we can add context to it depending on the viewer, right? If it's a PE login, we can have certain notes at the next to it and say, this is what happened to this vendor, to this client here this month, for any follow-ups, contact so-and-so, right? And for the CEO might be different, but that's what we're working towards. And I think that would be amazing. I think by end of this year, we will get there.
So if I heard you properly, your goal is almost complete transparency.
Yes.
Versus the traditional approach where let's hold the information until we craft the story and present the information and the story together, or the story first and then the information. What I heard is you're making all your information available weekly, almost instantaneously.
Yeah.
And I have to, if that's true, then it's apparent to me that your goal is to develop a tremendous trust bond with your sponsors.
Yes, absolutely. Because they will ask for it. What I've noticed, at least working with Blue Torches, they will ask for it regardless. And if we only sometimes we've tried it out where we maybe sent them half of the story or half of the numbers, and they're super sharp guys. I mean, they, especially when it comes to viewing numbers, maybe other things like technology or engineering, maybe that's not their expertise, but because they live in numbers all day, they immediately pick on stuff that even I was like, I didn't even think about that for a second, but now that they see it, you're right, that is a red flag. And let me explain that to you, right? So I think the fact that there's this super big trust, it's because also we need them. We need them to continue funding the business. And I want to make sure that they know that wherever their money is going, it's going to the right places. And so there's nothing that we're hiding. Now, of course, we may, before we share, there's a share button on the platform. Before we share it with them, of course, we can give them a contextual email, maybe give them a call, give them a heads up, and then, or do a follow-up meeting right after, because I think the story part is super important. But I think I want them to know, hey, there is nothing that we're seeing that you're not seeing.
You know what? The story will always get told. It'll always be told. It has to be told. But the way you're going about it, with being so transparent and not holding back information so the story can be told and so you can check in first and make sure they're okay with the story and then follow up with the numbers, which is kind of a traditional approach.
Yes.
I love the way you guys are going about it. And I got to believe your sponsors are enjoying the relationship with you as
Yes.
well.
Definitely, definitely. I think we've built a lot of trust over the last 2 years. I think that's why they keep supporting us. And I think, I even want to kind of bring them on. I mean, they brought on a strategic partner actually to help us with additional consulting projects. So I think it's definitely that partnership kind of feeling. It's not like a I'm scared or this is kind of holding company and we have to worry about stuff. It's really, hey, we want the help, and also we believe in ourselves enough on our numbers to back it up with what we said.
Well, I think you're also proving that you can be trusted enough with information, which opens the doors to other opportunities. You say, we want the help and we're willing to earn it by showing you that we're transparent, we're open, and we want to work with you as partners. So please be our partners too.
Right. Exactly.
Yeah,
Exactly.
that's fantastic. That's a great approach.
Thank you.
So let's shift gears a little bit. Let's talk a little bit about capital allocation. And I'd like to get a sense from you as to how you think differently about that when you're balancing reinvestment in portfolio companies against returns at the holding co level.
Right. It's a great question because um, around where to allocate capital. I think when it's a holding company structure, a lot of times we have to reward and look at what are the best performers and then be able to keep reinvesting there. And there are other areas where we have to make hard decisions and probably cut. So it's very much looking at it as a whole. And I think I've been lucky to work with a lot of investors that have a lot of discipline, which is they are not going to cash out early. They're able to wait for the right times. They're able to maintain that, hey, the business is worth investing for because of the markets going up or down. And so we're going to take advantage of that versus maybe it is the right time, let's say, to pay back debt sooner and where interest rates going. So there are a lot of calculations on their side, or maybe perhaps right now, taxes, like it's better to just pay this tax bill now instead of wait. So we got to, take this money out of the business, right? So I think there is a lot more financial engineering when it's at the holding company level, looking at capital allocation. I think specifically for a kind of smaller company, right, mid-sized company like Converge, I think pretty much every dollar that we're able to make, we are reinvesting in the company because there's a lot of growth continue to be had. And I think a lot of potential because we're definitely not the biggest player by far in this market. And performance marketing, lead generation, we're building first party data ourselves for the first time. That's a huge initiative. And we, the private equity firm actually looked at it for us, did a market study. It's a billions and billions of dollar industry that we're just taking a little bit of. And so I think that opportunity means we should be investing as much as possible back into the business versus just kind of taking it out in dividends and for us, like we just redesigned our bonus incentive structure where employees are incentivized if it's on growth and on margin. It's not incentivized based on just your performance or your base salary. Everybody's is tagged to the company's growth and the company's gross margins. And that's how we're paying that out this year. We're testing it out. So it's a little bit of a guinea pig, but I wanted to help align kind of what employees are getting rewarded at. And it's not just, hey, I check my boxes for my tasks, but the company is growing, or we built out this new product, we brought on these AI tools, and we see 2x, 3x growth, and then you're going to be rewarded outsized.
You're drawing your employees toward the center.
Yeah.
And you're actually putting them all on the same oar, and they're all pulling in the same direction. I mean, that's kind of
we're hoping so.
Yeah, I mean, that kind of bonus structure is really one that gets everybody focused, and it really takes out the, well, I did my job, he didn't do his job perspective, and brings everybody together. And we have to do our jobs in order to make this thing grow.
Yes. Yeah. It's the first time in this company's history that we're trying this. And I think, my CEO said it best, we're a performance marketing company. So let's make everything about performance, including kind of how we incentivize people.
And including, well, it's also how you talk to your clients about everything that's performed. That's great.
Yes.
That's great. So we talked earlier about shift in mindset. Beyond shift in mindset, what's one mistake you see CFOs make when transitioning from an operating role into either a PE-backed or multi-entity environment?
Because I've sat in different seats, both at the investor level, as a consultant back in my Bain days, worked for kind of operating companies, right? And now then startups, then now kind of at Converge. I think something, easy to make is an easy mistake to make is kind of doing the run of the mill reporting or not being curious enough and finding out what are the best newest tools and newest ways of doing things. And I mean that because I feel like there is more scrutiny when you join a private PE backed firm, whether it's from the PE firm itself or just from results, right? Because your results impact their results. And at a multi-entity, even more at the holding company, they look at results every year, and to make it up to the list of who gets what investment next year out of the whole pie, it matters how you're performing versus the other portfolio companies. I think when you're just an operator in a large corporate, it's easy to kind of just do check the box or have a system that's built out and just have it keep running and running and running versus constantly seeking for what's the better way of doing it. And also what are the newest things out there? Because I think, believe it or not, there's so much change happening in financial reporting, analysis software. There are a lot of new software tools. I'm actually going to a conference in about 10 days where I'm meeting with tons of new vendors. And I know probably half of them either maybe won't make it or I won't use them, right? But I think for me, it's about what are people doing out there? What are they trying to solve? And is it something that I should be thinking about? What are my peers trying to solve? And if we're not solving that, I mean, what's going on? What could happen in 5, 10 years? Like, with the advent of AI, will my reporting structure or my teams even look the same? I have one quote from a company, new ERP software firm, and he told me something shocking. He said he helped a company that grew from 20 million to 200 million in revenue, and they kept their entire accounting and FP&A team to just 3 people plus a CFO.
Wow.
So he's really saying with AI, like you can really leverage tools and not need to hire if you're using the right people.
Wow.
Yeah.
3 people.
Three
Yeah,
people.
that's a hardworking AI, I have to say.
It is. Yeah. So I was like, wow, let me look into that. How are you guys building that? Right. Yeah.
So, so earlier we spoke about how what I think is tremendous in terms of how you're incenting employees within the company, but what I'd like to talk a little bit about is management incentives across portfolio companies. How do you align them so that those incentive programs reinforce enterprise value creation?
Yeah, gosh, that's a hard one because I think I've not seen it ever work perfectly because what happens is as a portco or as a holding company, you're acquiring or bringing on companies at different stages and times. So you might be inheriting something already that's hard to change, either legally not possible to change sometimes, depending on when you acquired it, or there's a big cultural resistance, right, to change. And then you might have another portfolio company that you've had and you've built from the ground up. And so it's working kind of the way you are. So to make things consistent is difficult, and it's a longer process than most people think. It's not sometimes 3 years, 4 years, 5 years. It could take 10 years to kind of realign everybody and to also make people feel like it's fair, right? And that you're rewarding the best outcomes. And maybe it has to do with this particular management team needed it to operate this way versus this other one was more aligned with a sales incentive or with bonuses tagged to their salary, the more traditional way versus a newer way. So I think that it's a tough question. I've not seen it always done well, but I think one way to look at it is definitely, I think, again, going back to transparency and allowing also the portfolio companies to communicate with each other, and maybe doing also kind of CEO to CEO, CFO to CFO working tables and sessions to be like, we all report to the same owner. We're all part of basically the same family. How can we reward each other properly so that we all go into the same goal? And what are you doing better than I am? What am I doing worse than you are? Right. And I think coming together that way instead of having siloed portfolio companies.
At the very least, that kind of portco to portco communication can foster operating efficiencies, innovative ideas, which eventually can lead up to mirroring management incentive programs.
Yes. Yes,
Right.
exactly.
I mean, and as you said, CEO to CEO, CFO to CFO, middle management, down to rank and file employees, depending upon how much of an investment. The more communication among companies that have common owners and therefore common interests, the better.
Yes.
Right?
I completely agree. Actually, that's something that I've been trying to ask Blue Torch to do. I mean, they have about 80 plus portfolio companies, and I was like, we gotta talk more to each other, because there's not only a lot that we can learn. Potentially, I could buy software from the same people, or they could be clients of ours, or there's just so much germination that can happen there.
Right. And that opportunity gets missed tremendously.
Yes.
I can't tell you how many times I've participated on a smaller scale in organizations and associations for years, and recognized that the two people who sat across from me every month or every quarter at the same meeting were friends, and they chatted and they smiled and they laughed and didn't know what the other one did for a living.
Oh my gosh, what missed opportunities, Andy, right?
Tremendous
Like,
missed opportunities. And I became chairman of
yeah.
that organization. I pointed it out. I said, you two have sat next to
Wow.
each other for years, and I bet you don't know what you do for a living. One was in the construction business, and the other one was a civil engineer.
Oh my gosh, look, maybe that's why they were friends, but I guess they didn't talk beyond the friend
But they
part.
missed opportunities. So
Totally. Yeah.
elevate that to the
Wow.
portco level, and you're
Yes.
spot on. You could be buying from each other. You could be learning each other's efficiencies. You could learn what to avoid and what not to be doing.
Exactly.
I mean,
Yep.
before you get up into things like management incentives, it's a tremendous
Right.
opportunity.
Exactly. I think it's
Yeah,
across the board. Like, let's talk about sales and all that stuff and
sure,
methodology. Yeah.
sure. Well, I applaud you for thinking that way. Um, Well, listen, we could go on for hours. I'm having
Yeah. I love
so
this.
much
Yeah.
fun hearing your ideas and talking with you. I have one more question before we go. Um, if you could give one piece of advice to CFOs partnering closely with private equity for the first time,
Hmm.
what would it be?
Oh man, that's a hard one. I think I might have five, but I think that the top
You can give me more
advice.
than one if you
Yeah.
like.
Okay.
Give me
All right.
more
Sure.
than
I can. Yeah. I think the top one really is be open minded. That's number one. Be open minded, and then the other piece is never stop. I think being curious and learning, and then figuring out issues with the PE firm. I think it's they're a partner number one. They may not always come off the same way. Maybe they're not, your type of person you want to sit next to in a bar always, right? Depending on what your person is. But I think always remember that you guys have common interests and common goals. And so if they succeed, you'll succeed. And it's better to kind of get onto that early on.
I think that's very good guidance, because at the end of the day, the operating company went to the PE firm to accomplish something,
Right.
and both together can accomplish great things. And I love your approach. I think that's great advice, Ying. This has been a truly inspiring conversation. I've really, really enjoyed your conversations.
Thank
I hope we
you.
have a chance to do this again. I think
Same.
your I think your insights are going to go very far for our CFO audience. Thank you so much for joining me today.
Thank you so much, Andy. Really appreciate everything.
Well, this has been great. And I also want to thank our audience, ladies and gentlemen. I truly appreciate you joining us here today on CFO IQ. I'm grateful that Ying Miao of Converge was able to join us and share her thoughts with us. If you'd like to learn more about Ying Miao or Converge, you can visit them online or visit CFOIQ.com. If you'd like to be considered for an on-camera interview here on CFO IQ, visit us online or email me at andrew.zizas@cfointel with two L's.com. Thank you for being with us today. I'm Andrew Zizas, wishing you a productive and profitable day.
For booking inquiries, please visit cfoiq.com or email andrew.zizas@cfointel.com.